Good evening, and welcome to our financial markets update. U.S. markets were closed yesterday for the Independence Day holiday, so we're looking at the previous trading session where the major indices finished essentially flat. The Nasdaq closed at 25,832, the S&P 500 at 7,483, and the Dow Jones at 52,900, all with near 0% changes. Pre-market futures also showed no significant movement. One notable exception was Tesla, which fell more than 7% to close at $393.45. While this decline was close to our threshold, it didn't trigger a full verification. The drop was primarily driven by growing concerns over the pace of AI capital spending, something we'll continue to monitor closely. Now let's turn to the global macro picture. The yield on the 10-year U.S. Treasury note is currently at 4.48%, and it's been trading in a tight range between 4.45 and 4.49% over the past week without breaking through the previous high. This level suggests that liquidity conditions remain relatively tight, which continues to put pressure on growth stock valuations. But the fact that yields haven't moved higher indicates that the market is still digesting inflation expectations and rate cut projections. The VIX Volatility Index is at 15.81, which is in the lower end of the normal 15 to 25 range. This tells us market sentiment hasn't turned panicked yet, but historically when the VIX hovers around 15, it doesn't take much of an external shock to send it spiking higher. The US dollar index continues its weakness from late June, currently at 100.86. This dollar weakness provides some breathing room for emerging markets and commodities, and it's also a key reason why gold and crude oil have been relatively resilient. West Texas Intermediate crude is trading around $68.78 per barrel, stuck in a low range. The escalation in the Russia-Ukraine conflict could cause short-term supply disruptions, but global demand concerns are capping any upside. Spot gold is holding firm at $4,187.30 an ounce, benefiting from both a weaker dollar and geopolitical safe haven demand. On the currency front, the onshore yuan is trading at 6.7702 against the dollar, while the offshore rate is at 6.7837. The yuan has been moving in a narrow range between 6.75 and 6.80 recently, showing a slight appreciation trend. A weaker dollar helps ease capital outflow pressures and provides positive support for foreign capital inflows into A shares. However, we saw multiple negative developments over the weekend. The U.S. Federal Communications Commission rolled out a new round of import bans, expanding the scope to include older models from companies like Huawei, ZTE, and Hikvision. The Commerce Department also issued new rules closing loopholes that allowed Chinese overseas subsidiaries to acquire AI chips. The 2026 National Defense Authorization Act prohibits the defense system from using Chinese AI models, and the FCC will no longer recognize testing reports from Chinese laboratories. On a more positive note, we're seeing signs of a thaw in agricultural trade between the U.S. and China. The Commerce Ministry indicated on July 2 that both sides have established a framework for reciprocal tariff reductions to expand bilateral agricultural trade. The U.S. is expected to release its list of tariff reductions on approximately $30 billion worth of Chinese goods after July 10. Overall, technology decoupling is accelerating, but we're seeing some easing on non-strategic goods. For the A-share market, while there's no trading today since it's Saturday, we're looking ahead to Monday's opening. Our assessment is that the negative impact from the technology control escalation will fully play out over the weekend, and the market will likely open lower. The Shanghai Composite Index may test the key 4,000-point level, while the Chi-Next Index could see even larger declines due to technology stock weakness. For sector allocation, agriculture and farming stocks look attractive given the confirmed framework for reciprocal tariff reductions on agricultural products between the U.S. and China. This sector has strong policy support and has already undergone sufficient correction, giving it solid defensive characteristics. Energy and oil stocks also present short-term trading opportunities, driven by the Russia-Ukraine conflict pushing oil prices higher in the near term, combined with a weaker dollar. However, we strongly advise caution on technology sectors including AI, semiconductors, telecommunications, and consumer electronics. The tightening of U.S. technology controls, combined with domestic companies like ByteDance and Alibaba taking down their AI agent functions, creates a double negative for these sectors. Capital outflows are highly likely, and we recommend avoiding these areas for now. To summarize, the comprehensive escalation of technology controls is weighing on risk appetite. For defensive positioning, focus on agriculture and energy stocks. Overall, we expect the A-share market to trade with a weak bias in the coming sessions.